Let's knock out some multiple choice questions on what I think is a pretty interesting, fun topic, right? Aren't they all fun and interesting? Well, this one particularly fun and interesting here. Subsequent events. If a subsequent event occurs after the report date, but prior to the release date of an audit report, resulting in management's revision of the financial statements of a non-issuer, always take note, is this important? Is the fact that it's a non-issuer important? In some questions it will be, in some questions it won't. Then the auditor may do any of the following except. Let's think about this question. Let's think about the implications of it. Let's think about what could be relevant. We know when it comes to subsequent events, we have different dates regarding evaluation dates if you're an issuer or a non-issuer. However, I don't think that's going to play a role here. Let's take a look what our options are. Well, we've got concepts of dual dating. We could possibly see that here. Let's see what we got. Well, we could perform audit procedures necessary to obtain assurance about the revised financial statements. Okay, that's something we can do, regardless if it's a issuer or non-issuer. If we want to get assurance over this additional time period that was added, because what happened, we have a subsequent event happens after the report date, before the release of the audit report. So management revised the financial statements, and because they did that, right, they're new financial statements, and you need to now do work over whatever was revised. But we actually can perform audit procedures necessary to obtain this assurance. That's just more work. Now, you may want to dual date the report, do something like that. We are going to say that is not our answer because this is something that we can do. What about maintain the original date and state that the opinion is limited to the financial statements as they existed prior to the subsequent event? Now, this is kind of like a Frankenstein's monster sort of situation. This question's trying to hint at something, but it's actually not that, right? This is trying to kind of talk about dual dating the audit report, but this is actually not how you would go about it. Maintain the original date and state that the opinion's limited. No, you're not going to do that. That's going to cause too much confusion. So again, like you're not allowed to do this. Now you can maintain the original date of the report. You would dual date the report then, but this is not how you would do it. So this looks like it's going to be our answer. Let's see, letter C, include an additional date in the audit report that is limited to the revision to the financial statements. This is the proper method of how you would dual date it. So letter C is essentially the correct way of doing letter B. And lastly, provides the date of the audit report to reflect the necessity of additional audit procedures. This is something as well that we can do. So we are going to eliminate C and D on the basis that these are correct answers on what we can do. And let's just also look at snippet from the lesson. So we see here what happens if we have a management revision of the financial statements. If a subsequent event occurs based on information which is reliable and it will affect information that users of the financial statements will rely on, this event must be accounted for. Makes sense, right? If there's something that happens and it's going to affect the information that the users are going to rely upon, then yeah, we got to do something. If management refuses to account for this material event, the auditor should notify the client's board of directors about management's refusal to make the adjustment. Right, so here we go. This is kind of what we're talking about. What are our options? Discoveries made before the auditor's report date need to be investigated by the auditor. Discoveries made after the auditor's report date and before the financial statement issuance date, which is what we're looking at, are not required to be investigated by the auditor, but should be considered for disclosures or adjustments. So here we go. Letter B is our answer. Next up, we got another fun one here. Which of the following statements extracted from a client's lawyer's letter concerning litigation, claims, and assessments most likely would cause the auditor to request clarification? That's a little bit of a mouthful, so let's think about what this means. This is a letter from the client's lawyer. Presumably, this is the auditor reaching out to the client's lawyer saying, are there any pending litigations, any contingencies or commitments? And one of these statements is going to be significant enough and hint at that we may need to ask follow-up questions. So ideally, you're going to reach out to the client's lawyer, and the lawyer's going to say, okay, cool, yeah, nothing's really going on. There's no outstanding litigation. There's no potential liabilities that the company might have to account for. Oh, that'd be nice, but let's see what we've got here for answers. We believe that the plaintiff's case against the company is without merit. So these are items that, in this case, okay, there is a lawsuit going on. However, which of these is going to cause some concern for us? Here, we believe the plaintiff's case against the company, the client, is without merit. So this would basically mean that it's a remote possibility. As such, we would not disclose or anything with this. We would just ignore this. If the client's legal counsel is saying it's nothing to worry about, then I'm not going to worry about it. We believe that the possible liability to the company is nominal in amount, so basically immaterial there. And if that's the case, we're not going to worry about that either. We believe that the action can be settled for less than the damages claimed. Okay, so in this case, this could cause the auditor to request clarification because it suggests that there's a possibility that the company will be found liable for damages. So, right, if they are found liable and then they have to settle, that this would require further clarification. These other statements don't suggest that there's a possibility that the company would be found liable, and because of that, the auditor wouldn't request clarification. And then we believe that the company will be able to defend this action successfully. If you also wanted to take the approach of which one of these is not like the other, would be a good approach for this question. You see, it's like, okay, not a big deal, not a big deal, not a big deal. Oh, okay, there's concern to be had here. Final answer is going to be letter C. Looking good, looking very good. Let's move along. On February 17th, year 2, a company had a fire that destroyed a plant. The building and equipment had a net carrying amount of $550,000 as of December 31st, year 1. The company anticipates that insurance proceeds of $300,000 will be received. The audit of the financial statements, we've got an audit that's year-end December 31, year 1, was completed February 25th, year 2. As we're reading all this, we should be considering, okay, when did this actually happen? When should it be disclosed? Is this within our subsequent event evaluation period? Lots of items to keep in mind. How should the fire be reported in the financial statements for the year ended December 31, year 1? This one is going to have a time-old trick because, well, what happened? It burned down in year 2. We see it happened in year 2. So we know any answer saying that we should adjust the year 1 numbers is going to be wrong because it happened in year 2. Yeah, we should disclose it. Yeah, we should talk about it in the year 1 financial statements. But because it happened in year 2, we're not going to change the year 1 amounts. So let's look for anything like that. The loss should be recorded December 31, year 1. Nope. Right? We want this, the dollar amount accrual is going to happen for year 2 dollar amounts, so not year 1. So the value should be adjusted. Nope, we're not going to adjust amounts in year 1. The year 1 financial statements should be adjusted without disclosure. We are not going to adjust the financial statements. That one key kicker is going to save us all the tricks, all the headaches here. The year 1 financial statements should disclose the effects with no financial statement adjustment. Yes, I like that. I like that one a lot. Yes, it's a big deal. It's significant material, presumably. We are going to account for this by disclosing it. We're going to disclose it, let everyone know, hey, this happened. Look for it in the year 2 numbers. But it's not going to affect the year 1 numbers because the point of the financial statements is to accurately reflect as of that date. And as of that date, the warehouse had not burned down yet. Good. Well, it's a plant, not a warehouse, but same thing, different terminology. Looking good there. Last question here. Subsequent to the issuance of the audit report for the final year of a 3-year contract, a fact is discovered that may have affected the final year's report. Which of the following actions is the auditor required to take? Dun, dun, dun. You're required to do this. What are you required to do? Let's read through the answers. The auditor is required to determine whether the information is reliable. So let's just say we have subsequent to the issuance of the audit report. Let's take a look at a snippet from our lesson, and it is the same one from before. So discoveries made before the auditor's report date need to be investigated by the auditor. Because if it's relevant, if it's material, if it should be disclosed, if it should be accounted for, then we're going to have to do so. So letter A, the auditor is required to determine whether the information is reliable and whether the facts existed at the date of the report. I'm going to say that's looking like a good answer, but let's keep reading along. The auditor is not required to do anything because the auditor was discharged for reasons other than professional. Whoa. Okay. Professional misconduct. That's not looking good. But let's see. The auditor is not required to do anything because the auditor was discharged for reasons other than professional misconduct after the audited financial statements were issued. The auditor is required to do something. So, right, like they're saying it. Well, the reason it's bringing up professional misconduct is because if there's professional misconduct, the auditor is just not going to be associated with this anymore, right? You're getting kicked out essentially. The reasons other than that, even if you're discharged, you still have a responsibility there. And The auditor is not required to do anything, so we will have a responsibility to do something, which is evaluate if anything happened. So this fact happened. We need to associate, is this material? We need to figure out, do we need to disclose it or account for it at all? The auditor is not required to do anything. Again, I'm going to say that they have to do something, but it says, let's keep reading, because once the auditor has reported on audited statements, the auditor has no responsibility. And no, that's just not true. We do have responsibility. You're not off the hook yet. Lastly, the auditor is required to reissue the auditor's report and to reference discovery of the fact. So no, not necessarily, right? So this is subsequent to the issuance of the audit report for the final year. Actually, pardon. So I think I misread that myself. You look here. So discoveries made after the auditor's report date and before the financial statement issuance date are not required to be investigated, but should be considered for disclosures or adjustments. So that's actually the point we're looking at. But same deal. We need to do something in both of these situations. So regardless of this happening before the financial statement, before the audit report date, or after the audit report date, we need to consider these items. And are they material? Do they require additional consideration for disclosures or adjustments? So they're not required to reissue the auditor's report. They may be required to eventually, but the first step is determining if the information is reliable. Like if the information is not reliable, right? If we get some report that there's some problem, but it's not reliable, then we can't really go off of that. And whether the facts existed at the date of the report, but if it happened, if we should have known about it at that date of the report, if it was something we missed, right? If it's something we missed, then yeah, we kind of got to go back. You didn't do a full, complete job. You got to go account for it. So that is looking pretty solid. I am liking that. Good amount of questions here, and I hope you all enjoyed. I know I enjoyed. Have a great rest of your day. Keep studying, pushing through these lessons. You can do it. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.